one of the things that we really should talk about, because as much as metals have moved, one of the things that has happened is there has become an enormous spread between the bid side of silver and the ask side of silver. That's what I just talked about. That's so. But explain to it, because if somebody calls us in today or tomorrow and says, Andy, I want to sell 2,500 ounce bars, and we give them a number, we have to go off the bid side of spot, and that's going to be a bit strange when they're seeing it trading. Right. So explain it a little bit for us. Well, let me read something to you. My dear friend Michelle McCory just sent me, because I think it's important to understand. She sent me this. This is from the Perth Mint. I can't validate it, but Michelle is a pretty smart gal and said this is what she just heard. Perth Mint suspends silver sales amid global shortage. Australia's Perth Mint has halted all silver product sales due to overwhelming demand and supply chain issues, while U.S. dealer commercial rare coins and precious metals has frozen transactions as of October 13th, 2025. The shortage stems from industrial demand in solar panels, electronics, and EVs, outpacing mine production by hundreds of millions of ounces annually, driving spot prices above 50. That's not the reason, but that's part of it. Per ounce, and record premiums on physical bars. Experts highlight plummeting London vault inventories and refining capacity strains as key factors fueling potential further price increases. So the bottom line is simply this. Again, if I buy back metal from people, I have to hedge it. If we have 1 million ounces of silver in our warehouse and the price goes down by $1, we're dead. We lost $1 million. So we have to hedge it. But if able to hedge it with contracts, it's $3 back. What do? We have no choice. And if you look around, you'll see this is not just Miles Franklin. This is every company in America. Everyone's freaking out. Half the companies aren't even taking orders. Our supplier, one of our suppliers this morning, called us. Yeah, he sent an email saying that we're halting all trading until we get a handle on the premiums, on the availability, and on the spread. Reading that refiners are pushing retailers to buy back junk metal and sterling at 50% back to spot. Andy, what are you hearing? That's definitely not true. Not true. I think our buyback right now on junk, I think Josh just did the rewrite. I think we're probably around 350 back, somewhere around there. So about 350 back a spot, which is extremely competitive. It might be even a little bit better than that. I don't even know. But no, it's definitely not 50%. That's for sure. All right. And then we want to go to Earn Dog B. If someone were to have 1,000 ounce bars, would this be a good time to move them into small denomination bars? So because this being huge demand and get the same amount of silver back. If he did it into junk silver, he could probably. No doubt. Junk silver, no matter what, even still right now. And premiums, trust me, are definitely on the rise. When we got our wholesale numbers from the large wholesalers and distributors today, Silver Eagles have shot up enormously in premium. You will find that right now, most dealers out there are probably going to be close to about $8 over spot for Silver Eagle, roughly around there. So junk silver, you can still get very, very inexpensively relative to the overall market. So definitely something to look at. I'd also like to say people have probably read the Bloomberg article that's talking about the shipping of metal back to London. I think it's all bullshit. There's a little bit. You got traders taking advantage of that spread, but it's a cover story as far as I'm concerned to calm the nerves of the market. If supply were fine, they wouldn't need a PR rush in order to say everything is fine, is moving back there. The physical supply just isn't there. And you can't move enough metal across the Atlantic in a fast enough time to meet urgent delivery needs, which means you're getting margin stress. People are getting margin calls and they have to deliver or do something, and it's hitting the paper market. And this means leveraged players are under severe pressure, real pressure. And this is, I guess, a hallmark of illiquidity and forced liquidations. And it's going to start to hurt some big players in this market. This is the third person that's asked this question. So when will silver become a tier 1 asset? Any info or talks in the works? No, but it was reclassified a critical mineral. That's correct. Nearly the same thing. Right. They just asked the same question. Well, here's a great one. Habitat for Rockhounds, Jim Fry. What is the volume ratio of buyers to sellers at Miles Franklin recently? No one's selling. No one. Today I can tell you that I personally took probably about 45 orders today. Not one of them was a sale order. Not one of them was a buyback. 45 orders is a huge amount of business for us to do.
He says, this is a breakdown in confidence in the greenback as a reliable store of value. This is what markets look like when the world's reserve currency is at least partially losing its value or store of value function. It's kind of like your dollar is acting like a melting ice cube here in Aruba. He said that the denominator for all those asset prices, the dollar, is what's actually declining in value. He argues the erosion of trust in the dollar is the unifying factor behind soaring commodity prices. Tight credit spreads and strong equity markets. Real assets are well positioned to capture what the U.S. dollar has and is losing. It's true. And I don't know. I think this is just beginning. I truly do. I think it's going to get nuts.
Well, I think, and this is kind of a funny one, because Costco Online Joe Potter says Costco Online had 10-ounce silver bars for $569.98.
We're less than that.
Way less than that. Way less than that. So, but I will tell you, inventories are definitely depleting. I would say that, and I don't know if I said it already, but without a doubt, the most common question that we had today was, do you have any silver left? We do. But
don't look.
I'm not looking.
Don't look. What do you think gold and silver are up this year to date?
Silver is going to be up roughly about 75%.
72.
Gold's going to be.
Gold's going to be today.
Yeah, gold's going to be up roughly about 56.
54.16. Tattoo. Good job.
One of the things we really should talk about, because as much as metals have moved, one of the things that has happened is there has become an enormous spread between the bid side of silver and the trading price side you see quoted. And I want to explain that to you because if somebody calls us in today or tomorrow and says, Andy, I want to sell 2,500 ounce bars, and we give them a number, you need to understand why it may feel strange compared to what you're watching on your screen. Here's how it works. My dear friend Michelle McCrory just sent me something because I think it's important to understand. She sent me a note that says, Australia's Perth Mint has halted all silver product sales due to overwhelming demand and supply chain issues, while a US dealer has frozen transactions as of October 13th, 2025. She quoted a publication saying, the shortage stems from industrial demand in solar panels, electronics, and EVs outpacing mine production by hundreds of millions of ounces annually, driving spot prices above $50 per ounce and record premiums on physical bars. Experts highlight plummeting vault inventories and refining capacity strains as key factors fueling further price increases. Now, whether every single detail of that report is 100% verified, I can't guarantee, but what I can guarantee is that the trend is unmistakable and it's visible from many corners. From dealer emails to vault reports, the principle is clear. Physical supply is under serious stress. So here's the bottom line. If I buy back metal from people, I have to hedge it. If we have 1 million ounces in our warehouse and the price goes down by $1, we've lost 1 million. So I have to hedge to protect that. But what if I go and buy physical at, say, $52, and I try to hedge using futures contracts, and the futures contract is only trading at $49? The hedging cost is broken. I'm exposed. I either have to accept that exposure or reduce my volume, or both. That creates a situation where even if the headline spot price is, say, $52, the price at which I can liquidate or hedge might effectively be materially lower. That pushes down the bid side for someone selling large bars. It increases the spread between the price you see on screen and the price you net as a seller. When I talk to my suppliers, they're saying, we're halting trading until we get a handle on premiums, availability, and the spread. Now, a few people have reported refiners pushing retailers to buy back junk silver or sterling silver at 50% below spot. I will tell you, at least in our business, that's not true in our market. We're offering somewhere around $3 to $4 back from spot in some cases. That's still a big discount and unusual, but nowhere near 50%. So don't believe the worst case rumor without verification. But also don't dismiss the fact that spreads are weird, premiums are high, availability is tight, and the system is strained. If someone asked me, should I move 1,000-ounce bars into smaller denominations right now because of this huge demand and premium? I'd say yes. Think about liquidity. Smaller bars, coins, rounds, they tend to trade more easily, especially when supply is stressed. The premium for small denominators will go up, but the ability to move them is better. Speaking of premiums, we are seeing them blow out. One dealer quoted a 10-ounce bar at $569.98 when spot was substantially lower, a clear sign of skyrocketing premium. We are still below that in our buy-side stuff, but mark my words, inventory is depleting. The question you'll start hearing every day is, do you have any silver left? And the answer will increasingly be, yes, but don't look. We're watching closely. Why is all this happening? Because the system is telling you something. Physical is being demanded in increasing volume, while paper promises continue to dominate in a massive way. The discrepancy between what you see quoted and what you can actually trade or hedge is growing. To give an example, in the London market, the London Bullion Market Association, LBMA, there may be a free float of only about 140 million ounces. Yet paper trading volumes run to hundreds of millions of ounces. The physical backing ratio is getting worse. The lease rates for borrowing physical silver, so you can deliver it short, have spiked into double digits, even into the 30 to 40% or higher zone in London. That tells us that no one wants to lend physical silver because the cost is now huge. That's a clear stress indicator. And if you're a large buyer, or a refinery, or a warehouser, you're asking, can I trust that if I buy silver, I can hedge it? Can I deliver it? Can I sell it at something near cost if I have to? When the answer becomes no, you adjust the bid downward, or you don't buy at all. That means the spread between bid and ask grows. It also means the risk premium built into physical products goes up, so you'll see bids a few dollars under spot for large bars, even as the quoted spot is moving higher. With all that in mind, if you're considering buying silver right now, here's what I suggest. Start with a core position. Understand that the market is tightening, so building your position gradually, dollar cost averaging, makes sense. But also recognize that this is not just another cycle. The fundamental backdrop is changing. The best value in the market right now, in my view, is pre-1965 junk US silver. Dimes, quarters, and smaller bar coin denominations. Why? Because they're legal tender in many states, they have excellent liquidity, and they're simpler to move. Also, the supply is being eaten away. These coins were never reminted after 1964 in the US, so every time someone sells, that supply is consumed. We are seeing refiners telling people, we can't handle more scrap today. That is extremely unusual in the metals industry. Many people are asking, is it too late to buy? My answer, not at all. The long-term trend is extremely bullish. Yes, you may see pullbacks, corrections, rattles, but we are in the early stages of a structural shift. So if you haven't got exposure, get some. If you've got exposure, keep building. But buy physically, not promises. Because in times like this, physical possession may be the only thing that matters.